All right, a quick peek here. We're down about 55 points on the Dow. The NASDAQ, which was looking at an intraday high literally more than about a half an hour ago, is gone reversing here. A lot of it in these big technology names that dominated, but I know it does seem to be an across-the-board technology sell-off influencing Dow and other players, including IBM and Cisco, Apple, Microsoft, Intuit, Google, Facebook, Qualcomm. Again, some of the who's who of tech land here. But again, these are the same issues that have been running up far and fast. Now, you could assign a lot of this to the dollar, and a lot of these companies do a lot abroad. So maybe the thinking is all of a sudden would they be hurt by declining dollar? Just the opposite. But again, the stuff that they take into this country could be affected as a result of that, too. But be that as it may, this sell-off in a group that has been the leader in and out of this, you think about it, 9-year-long bull market. If you had to put a single group that has kind of led the charge throughout, it would be that technology group. And certainly over the last year or so of the Trump presidency, it has been. We've got market watchers Scott Martin, John Layfield, Carol Roth. Scott, what's going on here?
Neil, I think this is one of the fearsome areas that the market is looking at, where with respect to the tariff talk that is now back on the table, remember the market had a similar reaction back when the border adjustment tax was in play, and it looks like the market is starting to, let's say, extrapolate this beyond the solar panels, beyond the washing machines, which, by the way, full disclosure, we own a Samsung washing machine. Thank goodness we bought it in 2017, I guess. It's a great product. But it's extrapolating beyond those areas where maybe, the iPhone, which has many, many international components, becomes subject to some tariff or at least some sort of tariff war with other countries. So to me, it's the market overreacting to what I think President Trump is saying is maybe the big talk, small stick with respect to how he's progressing with this thing, because I don't think it's much to worry about long term.
Yeah, and I don't want to assign more to this than is worth the attention. Looking at the 75-point sell-off or so right now, it is all the more noteworthy today, given the fact we're up better than 150 points. But, Carol, your thoughts on this and the dollar thing that got talked about today when we seem to embrace, or the Treasury Secretary, Steve Mnuchin, did, a weak dollar policy. What did you think of that?
I think that we've forgotten that volatility is a norm in the market. This is something that we should be seeing. I actually applaud the fact that we're starting to see a little bit of volatility. So I certainly don't think it's anything to panic about. But I do echo some of Scott's comments and concerns that this talk about America first, we have to make sure that whether it's Trump or Mnuchin or Cohen or whoever's creating the policy is really focused on incentives and not disincentives. We have seen, obviously, great reaction from things like the corporate tax cuts and the repatriation. But when you start getting into taxes and penalties, it doesn't work. We saw that under Bush with steel. We saw it under Obama with tires. That cost a lot of jobs, and it had a big negative impact on the economy. So hopefully that talk will turn around, because it's certainly not going to be a good thing for the market or for the economy.
A trade war generally would not be a good thing, John Layfield, especially this thing with South Korea and China escalates to other countries. Reading the Canadian press, the Mexican press, they seem to be fearing just that. Are you?
I am. I agree with Scott. Like, the scariest thing on President Trump on the campaign trail was what we were hoping was just rhetoric, was the border adjusted tax, which has been dropped to pay for the wall and to make America more competitive. Talks of dropping out of NAFTA, the TPP, which we did, and other tariffs that would come in place. And I think we're starting to see the tariffs now come into place. And I think the escalation of this is the worry. This is not that big a deal with the solar industry. It is going to cost jobs. It's going to cost large-scale solar installations. It is only about 3% of total cost for home solar installation, because 95% of it are panels are taken from overseas, but only 30% of the cost are from panels. But it's a slippery slope. The Smoot-Hawley keeps being brought up. That was on 20,000 different products back in 1930s. There's no comparison right now, but the slippery slope is what people worry about.
Yeah, a lot of people say that triggered the Depression, all of that. But Scott Martin, down 103 points, and there are times in these type of moments where people either, run with it and escalate the selling, or there's a Pavlovian response to dive in and buy the dip. What do you tell your clients?
We're the Pavlovian experience, I guess, Neil. We're diving in, and Carol's right. It's funny. You guys forget, people probably don't notice this, or people already forgot how easy of a ride 2017 was. There was 8 days in 2017 where the S&P 500 moved up or down 1%. Can you believe that? In typical markets, that's in the 30s or 40s as far as number of days. So Carol's right. Volatility is definitely back in the markets in 2018, and that's good for those that have held some cash, because if you have cash that's sitting on the sidelines, you have to hold your nose and dive in when the markets drop.
Carol, the underpinnings, we're told, are still very bullish. What companies are doing with their money, still very bullish. A lot of bonuses going around, a lot of stock gifts and grants to workers going around. You have someone like Goldman Sachs CEO Lloyd Blankfein crediting the president for this improvement in the economy. His counterpart at Morgan Stanley, Jamie Dimon, talking increasingly about a 4% economic pop this year. What do you think?
Yeah, I'm a contrarian, so I'm always very uncomfortable when I don't have anything bad to say or, any sort of concerns. So this is one of those times when I'm sort of, other than this tariff talk, shaking my head. We have an unusual situation that is just great across the board, where we have growth. We have growth not just in the U.S., but on a global basis. We have low inflation. We have low interest rates. Even if the Fed does 3 or 4 raises this year, we're still not going to be at a level where it should impact markets or the economy. So we're in a really good position. And the only thing that I don't like about it is that I can't figure out what I don't like about it.
Oh, that's interesting. John Layfield, I want to get your thoughts on something that, John Paul Zajorian was talking to me about, the billionaire, of course, who was saying that in this environment, he welcomes companies sharing the loot from these tax cuts. React to this. What do you think of the president's stance on all that stuff?
Well, once again, I don't quite agree with the president's demeanor, and I've been very vocal on that.
You have,
However, but some of the things he's doing, with all due respect, work. Oh, my gosh. It works, and it's some good things.
All right. He was talking about the personal style of the president versus his economic policies. Doesn't think he always says the right things, but he seems to be saying he is doing the right things. What do you make of that?
He is, and these companies are doing the right thing as well. And who cares if it's for a marketing ploy or not? They're doing the right things for employees, and these employees that are getting these $1,000 bonuses, this is significant money to these guys. And these companies, once you get back this tax cut, I don't think these tax cuts have been fully factored into earnings estimates yet. It's projected that earnings estimates of banks are going to go up 20%. We don't know that yet because the analysts have not come out with those yet, and banks are only about 10%. So we should see about another leg up from this market from these earnings estimates, and these companies are certainly doing the right thing, which is a positive. There's a lot of negative and polarizing things out there about our president, but this is something that is very good and very good of these companies.
There are a lot of things that could affect these markets going forward. Black swan developments, unexpected developments. We talked about trade, all of that, Scott, that if it gets to be a trade war, I still think that could be, that's unlikely. But that just the moment at which gravity would have to take hold, and obviously even a 5% correction, which would, I'm sure, be deemed healthy, is in order. What would bring that on? Outside developments is one thing, just sheer, gravity is probably another. What is it for you?
It's time, Neil, and it's time from the standpoint of the market has been going along on this very nice, quiet, peaceful walk. As I mentioned, how low volatility has been, as Carol said earlier, in the last, say, 12 to 18 months. It's just time that's running out with respect to that market cycle. But to your point, it doesn't mean that the market needs to have a down year. It just means that you're going to have a few more, let's say, bumps and bruises and ups and downs this year. So if you're sitting at home being like, okay, what does that mean for me? It means you need to check your asset allocation. It means you need to have things in your portfolio that may act contrary to, say, just an uproaring bull market, so that if you do have these volatile days like we're having, let's say, today and maybe tomorrow, next week, and so forth, you have things that will at least soften some of the blows of a down day that is in largely an upward sloping market.